Subscribe and click the bell icon for the latest updates and notifications from the Indian Express.
Good evening, ladies and gentlemen, and a very warm welcome. We'd like to welcome our chief guest today, Mr. Deepak Parekh, Chairman HDFC, our esteemed members of the jury, our partners and our participants, and of course, ladies and gentlemen, we want to welcome each and every one of you, our special guests right here at the special edition of Financial Express CFO of the Year Awards 2019. Financial Express CFO of the Year Awards celebrates excellence, best practices, and outstanding achievements by India's leading financial officers. These are individuals who have established themselves as strategic thinkers, trusted advisors, astute leaders, and above all, masters at asset management. The awards recognize and reward companies and professionals who have enabled businesses to go beyond the ordinary. So, ladies and gentlemen, this evening will be divided into two parts. We will have a panel discussion by our industry leaders, followed by the much-awaited awards ceremony. So as we proceed further this evening, may I request you, if you are tweeting, and I hope that you will be, about the event this evening, please add the hashtag FE CFO Awards. Ladies and gentlemen, we now take this opportunity to thank our partners, associate partners, Hirunandani Group, New India Assurance, MIDC, and SAP Concur, Auto Partner, Volkswagen, Knowledge Partner, Deloitte India, Television Partner, BTVI, Outdoor Partner, Bright Outdoor Media. Ladies and gentlemen, let's begin this evening. May I now request Mr. Sunil Jain, Managing Editor, Financial Express, to kindly join us on stage for the opening remarks. Ladies and gentlemen, Mr. Sunil Jain.
Good evening, ladies and gentlemen, award winners, members of the jury, our chief guest, the doyen of the financial world, Mr. Deepak Parekh, our knowledge partner, Deloitte. Ladies and gentlemen, a big thank you for being here this evening. This is our third year of the CFO Awards, and thanks to a great jury, we have yet another year of great winners. The jury, as you know, was headed this year by Leo Puri, who used to be UTI MD, Amit Chandra of Bain Capital, was there Pradeep Shah, who's here with us this evening, Paresh Sutankar, who was the ex-Deputy MD of HDFC Bank, and Manish Kejriwal of Kedara Capital. So it's been a fascinating journey these last 3 years. And typically as journalists, as economists, as commentators of any sort, we tend to be focused more on the big number, the GDP, inflation, sales, profits. This award, unlike other awards, is about the people who are behind the scenes, who make these things happen, who make sure that companies pay their bankers, who make sure that companies remain solvent. So in a sense, the CFOs are the conscience of the company. These are the people that we're trying to reward and award this year. These are trying times. I mean, you've seen the last few years have been very, very tough. These are times where obviously CFOs have had a tough time. And I'm sad to say that times are going to remain tough, or they're going to get tougher for the next few years. I think the economy is definitely slowing. Even if you go by the inflated GDP numbers that we have, even by that standard, the economy is going to slow down, whether it's jobs, or whether the jobs are there, but the salaries are too low, whether it's the farm distress, which is partly large production, partly low global prices. Both of these have ensured that consumption is slowing down. Fitch, we saw just a few days ago, they downgraded their estimate for FY20. I'm sure a lot more will follow over the next few weeks, months. And the most critical thing for CFOs is that apart from the local factors that I've talked about, global growth is slowing in a big way. We've seen, whether it's the German bonds or the, Japan or US Treasury, basically the yield curves are all suggesting that we're looking at possibly a recession, but certainly a dramatic slowdown in global growth. So I think when there's a slowdown in global growth, there is going to be a huge impact on India. For those of us who think that the UPA growth was spectacular, if it was in a large number of years, but the UPA growth was primarily a reflection of where global GDP was in those days. So the combination of global GDP booming and cheap, easy finance from Indian banks, possibly with a nudge from the government of India. But that's something which is not, both those things are not going to be available now. So global growth is not going to make exports boom. And I think with all the problem of NPAs, the days of easy money from Indian banks is clearly over. I think there's a fair amount or a reasonable amount of uncertainty right now as to who will come back to power in May, whether it's going to be the present government in a majority, present government with coalition partners, or maybe just not the present government at all. But whoever comes back, whether this government comes back, a lot of the moves they've made, which are good moves, GST, RERA, the whole move towards getting more white money into the market, all of these are reforms which are designed to slow the economy down. These are not reforms that are going to make the economy grow faster. So, while it will take time for IBC to start yielding results, everything in the system, global growth and local factors, are basically telling us that that Indian growth is going to slow down. There are larger issues like telecom or power, where the government has been able to make the necessary reform. Once again, that points to global growth, for Indian growth sort of slowing down. So I think CFOs in this room are going to have a tougher time. The good news is that over the years we found that even in tough times, we've had enough CFOs who've won these awards because they've done a great job. The normal practice for all such award functions is to get a politician to come and give you gyan. So you'll have the finance minister or some minister like that who'll come and give you gyan. We made a conscious attempt for the CFO award to move away from that practice. So, we've had Bibek Debroy. Now, Bibek Debroy had a official designation. He was in Niti Aayog at that time. Now he's the head of the Prime Minister's Economic Advisory Council. But the big thing for Bibek Debroy was his knowledge as an economist. So he brought that expertise to this group, to this room full of experts. He gave them, knowledge of what the economy would be like and what to expect. This year, we've got the doyen of the financial world, Mr. Deepak Parekh. If you can all join hands to welcome him. We've got Mr. Deepak Parekh, who's going to give you insights, on really what the future has to hold for you. And before that, we have a very good panel discussion with some very, very good panelists, basically looking at what contributed to the balance sheet crisis that we had, and how are we going to ensure that we don't repeat the mistakes of the last time around here. The last time that we had a balance sheet crisis, it took, on average for most countries in the world who have a balance sheet crisis like the United States, it takes 10 to 12 years to get out of it. We've passed 7 or 8 years in India. I think it'll take a few more to get out of it. But we're going to have a panel discussion and we'll discuss what are the problems, whether the regulators have actually taken action on some of these. And with that, so I leave you back in the hands of our MC to conduct the rest of the evening. Thank you very much again for being here. Thank you.
Thank you very much, sir, for setting the perfect tone for this evening. Ladies and gentlemen, we promised you 2 parts to the evening, and we now move into our very first part of this evening, the panel discussion on a topic, has over-leverage killed India Inc.? I would now like to welcome on the stage our panelists. Please put your hands together as we welcome Chief Executive Officer, Aditya Birla Capital Limited, Mr. Ajay Srinivasan. Welcoming on the stage our next panelist, Founder, Ind Asia Fund Advisors, Mr. Pradeep Shah. Please welcome on the stage Executive Director, ICICI Bank, Ms. Vishakha Mulye. Joining us on stage, Founder and Managing Director, Institutional Investor Advisory Services India, Mr. Amit Tandon. Ladies and gentlemen, our final panelist, Executive Director and Chief Financial Officer, Tata Steel. Please put your hands together for Mr. Kaushik Chatterjee. Well, ladies and gentlemen, we look forward to him joining us on stage shortly. But right now, please welcome, moderating this session, is the Deputy Managing Editor, Financial Express. Please put your hands together for Ms. Shobna Subramanian. Inviting you, ma'am, to please take this session forward.
Good evening, everyone, and thank you for being here. As my colleague Sunil was mentioning, it's been a tough few years for corporate India, and I agree with him that it's going to be tough for the next few years too. And one of the reasons for that is that India Inc. still remains highly over-leveraged. So this evening, we're trying to find out how over-leveraged we are, whether we have crossed the hump in terms of the NPA cycle, and whether companies will be able to borrow again soon enough so as to be able to finance capacity expansions and investments. The private sector in particular has not invested over the last few years. And we'll also try to understand and assess the learnings that we have gathered over the past few years. I think we should first try and assess how far away we are from the next investment cycle. So, Mr. Shah, if I could just call on you to, give us your sense of, because private capex continues to fall, the project sanction data is shocking for FY18 and FY19. So, how far away are we?
Because of capacity having been built up, you're seeing a slowdown in capacity as demand catches up with capacity. I think the cycle will come back. Going forward, growth will continue. We are even now seeing 6.8% growth in real terms. So capacity utilization will improve and then the cycle will come back. But leverage was a thing of the context of the past when there was growth followed by and concomitant with that optimism. And of course, family groups did not want to dilute themselves. And therefore, they started borrowing, and money was easily available. Banks were willing to lend. Everyone was willing to lend to these companies. There was so much optimism. And so when easy money is available, you don't want to dilute, and you can avoid dilution, of course, people borrow. And that was the genesis of this problem that we've seen, especially in the infrastructure sector, where you had situations less than 2 years ago, even a year ago, where even the EBITDA didn't cover the interest portion. It was on a regular quarterly basis, we saw that in listed company, and no action was being taken. That was the time when banks and, of course, the promoters could have taken some preemptive action. But that was not taken, and then the IBC came in and it's precipitated the issue.
The IBC puts lenders on a very strong footing. At least, there is some sort of regimen to the process. But Vishakha, if I could ask you to weigh in, will bankers lend to infrastructure anymore?
See, I think, whether the bankers will lend to infrastructure all depends on the risk and reward that you get. If you go by the past, that risk reward has not really worked. So, of course, in the future, if we get enough, reward for the risk that we are taking, I'm sure they will lend to the infrastructure. So, I think it all depends on how this entire area spans out.
But typically, banks should not lend to infrastructure, right, because of the ALM mismatch. So, where are companies going to be able to find the debt?
So I think there are lots of new intermediaries which are coming. Unfortunately, we did have an intermediary called developmental financial institutions, and somehow that model did become quite outdated because of the precise problem that you're talking about, which is there were no long-term liabilities to actually support the asset creation in the country. But I think there are new intermediaries which are emerging with the development in the financial markets. I'm sure the pension funds and insurance companies will be the natural providers of this capital. We are seeing a lot of international investors coming to India, such as pension funds. We read every day. We have a lot of Canadian pension funds coming to India. Now, the precise idea of these pension funds is to actually look for long-term assets which will give them a consistent return. And I think a country like India, where infrastructure not only is required, but I think where people are willing to pay for the infrastructure. And we have seen that time and again in various sectors, including roads. When the first toll road came, the biggest question mark was, is there somebody who will pay for the road? But I think those worries are behind us today. And the growth coming back, wealth creation, I think that will happen. And therefore, these are the intermediaries which probably will hold these assets. I think the model which will emerge would be that the banks or people in India would have to take a risk during construction, which is going to be 3-4 years, and then probably go down and sell these assets to such investors.
Ajay, do you think, from April 1, companies have to borrow 25% of their annual borrowing requirements from the bond markets? Do you think this will work? What happens if there are defaults? And because you don't have too many highly rated companies. And, for the less rated companies, the yields will really shoot up.
Yeah, true, Shobna, but the 25% rule applies with a minimum credit rating. So in that sense, there's already a gate for the companies that will come in. But I think the issue is less with supply. I think there's adequate supply between government off-balance sheet borrowing, infrastructure companies borrowing, and of course the new supply that you'll see from public companies, like you said, more than AA, who'll have to borrow from the market. I think I'll go back to Vishaka's point because I think the issue is more with the supply side, with the demand side. I just don't think we've got enough demand for corporate bonds yet, and I think we do have to tap pension funds and insurance companies. I mean, the insurance industry has about 32 lakh crores of assets. The pension fund industry is even bigger. A lot of those investment norms are slightly outdated, I think, and need to be revisited because a large part of that money still goes into the government in some form or the other. So I think revisiting that will actually free a lot more money that will then become demand for the corporate bond market, and I think for some of the projects that you were referring to Vishaka about.
Okay. So, Amit, if I could ask you, is the 70-30 debt equity ratio that we followed all these years sacrosanct? Do you think promoters have enough skin in the game, or have they had enough skin in the game?
It's interesting. Till Kaushik joined the panel, I would say that all the other panelists had a long stint at ICICI. And I remember from my days at ICICI, we were told that you begin with a 2:1 debt equity ratio. And that was kind of pretty much the rule. And depending on who the promoter was, on what sector, and whether it was in what was called a backward area then, you had this amount of promoters' contribution. Then suddenly it became, 1.1. became the accepted wisdom. And for a long time, we kind of persisted with this 1.1. And then suddenly, I think after some time, after 2002, 2003, when companies started doing well, and there was this mad scramble for the power projects and coal mines and infrastructure projects, etc., we kind of pushed all this away and said we need to kind of move to cash flow-based financing. And therefore, ratios like even 2.3:1 or 70-30 would be fine. In fact, I remember reading a discussion paper which was there when the ultra mega projects were coming up, which said that you need 5% equity and 95% could be debt. But all that presupposes that the rest of the pieces are kind of working. So when Shaka spoke about the fact that, you're going to give money to the road project. Of course, people will lend to the road project, but what else is required? Earlier, when people were lending to the road project, they were quite happy to say, okay, you've got the concession agreement, let me lend. Now they want 70, 80, 90% of the land to have been acquired before you do that. So that kind of applies for all these. Whether it's 70-30 or whether it's 1:1, depends to a large extent on the other factors which you need to take into account. Is the concession agreement in place? Is the land being acquired? You're dealing with state electricity boards. Do they have the necessary money? And somehow we've all forgotten the fact that the judicial risk is very high in this economy. And therefore, you need to factor, build in a layer for that as well. So I don't think I've given a straight answer to your question, except
Mr.
to say
Shah
that
will give us
we need
that
to look
answer.
at the risk more broadly.
Do promoters have enough skin in the game? Because one big reason, as the former RBI governor pointed out, is that, Raghuram Rajan, that promoters just don't have enough skin in the game, and that's why they have no respect whatsoever for the sanctity of the debt contract.
It's not promoters not having skin in the game. There are professional companies, professionally managed, where the managers have no skin in the game, but they run very well. It's, I think, this heuristic, this thumb rule-based debt equity and so on. Actually, at the end of the day, as Amit was pointing out earlier, you have to go for cash flow-based lending. And, Tatas have shown the way in, managing even high debt with their cash flows, reducing when it comes to the crunch, selling off assets, and then getting to the projection of cash flow, what will come out, that should determine what the debt capacity is. In general, I'm a risk-averse person. I don't like borrowing. But optimal debt is a good thing, in a company. That is what gives a good capital structure, good returns to the shareholders. So optimal debt is all right. Then when implementation risks and so on come, and sometimes they've not factored them in, these uncertainties, then that optimal debt becomes suboptimal, the debt burgeons, and then, of course, you have these problems come, even when the management is good. But when you have other issues with the management, then, of course, you're compounding the problem from the very start.
No, I mean, you are a company which was at one time very, very highly leveraged. But, I mean, obviously, you have managed your debt well. But in general, do you think that promoters have got away lightly? Going by the NPA numbers, 12 lakh crore, now we have 8.4 lakh crore of loans still with loss-making companies.
So, it's obviously a subject which has got many angles. See, debt, I have always considered debt as the best form of non-permanent capital, but it has got an obligatory nature to it. And if one is funding projects or growth with debt, and if you're managing the underlying deployment in an efficient manner, and if you have understood how risk plays out in the business, and you've also understood or taken on that every capital, whether it is debt or equity, has to be serviced in the manner it should be, then there is a cascading impact on the wider organization. And I'm saying this as a manager, that everybody knows that there has been a debt raised for a deployment. We better make a good project out of it. We must get the cash flows that has been used to raise the debt, meet the expectations of rating agencies, lenders, and equity shareholders. So if this is the mindset, it's a very simple thing, that I have taken money and I got to return that money at the terms that I have to give back. And therefore, if I have taken that money, I have to deploy that money in the manner at which I had promised. So no cost overruns, do the project tightly, negotiate with suppliers to ensure the costs are done, no funny games, and implement the project well. And if I'm in the right business, if I know my business, I should create value. If you use debt in inorganic circumstances where the business judgment is higher and somewhat uncertain compared to an organic growth, then it's a question of managing risks, because there are uncertain element. You're walking into another company, you've deployed a significant amount of capital. There are external impacts which may affect the company. So that's a risk management issue. And as Pradeep mentioned, if it doesn't go well, you got to be proactive to take steps, hard steps, difficult ones, to come back to the same level. It may take time, but that is not at the cost of the lenders and not at the cost of the providers of capital. So if you have displayed this philosophy over a fairly long period of time, I think providers of capital are also comfortable that this is a responsible corporate. And if we can move to that state, then there is an inherent deterrence within the organization to ensure that we remain obligated to service the capital that we have. That's how I see it, and that's how our system sees it. And that's why I think that is not a negotiable issue. There's nobody taking for a ride. If Vishakha comes to me and says that this is the project and we are happy to provide capital, it's more than her. I would be responsible that I need to service the capital the way and the assumptions on which she is giving me the capital.
So let's get back to the question, Ajay. So is India Inc. today in a position to borrow, or how much would you say can they borrow to be able to fund the next investment cycle? Because the NPAs are not over. There's still power assets, there is real estate, some amount of telecom, I would think. So the NPA cycle is clearly not over. So is there money in the system, like you said, the demand side? How much, is your sense? How much can they borrow to fund the next cycle?
So I think some of the questions are slightly higher level. So I think it's important to answer the question at some granular level. Because at one level, if you ask whether India is over-leveraged, I would say look at an aggregate number. Look at credit to GDP, for instance. We are still significantly lower, whether you take households, you take corporates, you take government. We're significantly lower than most other places in the world. Definitely the larger economies that we want to compare ourselves to. The problem, I think, is arisen because the credit to GDP ratio actually rose very quickly. And whenever that happens, and then you have a plateauing of credit GDP ratios, you end up with somebody who's probably borrowed a little bit more than they can service at that point in time, and specifically in certain sectors. And I think that's what we're seeing play. I think to generalize that overall to say, therefore, India Inc. won't get money or nobody will get money, I think might be stretching it a bit too far, because I think there is money available for projects and corporates that have displayed good governance, displayed good management capabilities, displayed good financial prudence. I think money for them, I don't think will be an issue. And I think more recently, at least with what we've seen with the RBI, I think foreign markets have also opened up. And I think now you have other sources of capital in addition to some of the ones that we've spoken about now, which I think again changed the game in terms of the supply of assets available to those who are able to borrow. Okay, then Vishakha, do you think promoters have equity capital? Because, a lot of the projects for, say, mid-tier groups, GMR, GVK, to fund the next investment cycle, do they have the equity? Because, even NBFCs don't have enough money today to lend, or there is a shortage of equity capital in the economy.
So I think it will be very unfair to generalize a statement. Many of these sponsors, even though they don't have cash, I think they have sources of capital. And when I say sources of capital, they have lots of assets which they are already invested in. So the names that you took, right, GMR, they have, Delhi Airport, and which can be diluted to provide capital for the next phase of growth. Similarly, I think one has to look at, and I think somewhere as a corporate India and generally as a philosophy, I think people will have to live with the lower, percentages. I think somewhere we are used to saying that unless I hold 51% of capital, I cannot control the company. I cannot run the company. As we start growing and, the project costs are going up, and sure, the kind of scale that we will see in India over the next 10 years is just going to be too large for any one individual or a corporate to meet their aspiration or the aspiration of India going forward. And therefore, there will be institutional capital which is available. If you look at internationally in most of these advanced countries, I think people are happy with a lower, percentages. And I think somewhere that equilibrium will come where even corporate India will feel comfortable to operate their companies at those levels.
So Shobna, if I can just, I think both Vishaka and Pradeep are actually good people to ask this question to, because I think one of the things that's changed in response to your question is the growth of private equity. Yeah. Because for a long time, we just didn't have other providers of equity capital to a promoter or to a company. I think with the rapid growth of private equity in general, I think a lot of that has changed. And I think Pradeep and Vishaka from an earlier role would be good people to talk about that if you ask me.
But I mean, will promoters, the question is that do they have the money, even if PE comes in, even to fund 26% growth? I don't think any promoter in India will live with less than that because they're just not used to it. So do you think that there is money even to put in 26% capital into any venture?
You were aware of Tata Steel at one time. The Tatas used to control it just because of their reputation, not by control of shares.
The Tata
and then they
group
gradually increased it. They are different philosophies, different people. So again, Kaushik mentioned about how you have to sell assets when if your going is bad. I remember years ago when I was in the rating business talking to LM Thapar. We used to have an interview on financial flexibility and amongst other things. So he said, Thapars never sell assets, never sell businesses. There was on the other side, Aditya Birla. I remember talking to him again, interviewing for his business. He says, we will not set up a project unless all our funding is tied up. Now you saw in this last few years, people went on with projects because the project was too good to resist. Infrastructure project, you had to bid for it, you got the bid, and then you had to line up the funding. So you were committed to the project, but you didn't have the funding, so you had to go along and improvise and raise the funds as you went along. Now that's where greed, you didn't want to dilute, you didn't want to give away equity. But if you were to give away equity at the time when optimism is the greatest, when you're implementing the project, not after the project is implemented, you could have raised money. So private equity would come in, private equity from various sources. At one time, the public was the private equity provider. You remember in the 60s and the 70s, there was no private equity concept. ICICI and others used to provide capital, but otherwise it was the managing agents who, because of their reputation, they would manage to get capital into the company. So India has provided private equity, not in the fashion that we are now providing through private equity institutionalized sources. Not enough. There is always going to be a shortage of equity capital in a growing economy, which is so essentially needing capital. But there will be available capital for good projects, there are good managements, and as Kaushik again pointed out, if you have prepared the ground for a track record that these guys are determined people, they'll see the project through, they'll return their debt as they do, they get the capital.
Amit, can you think, just off the cuff of half a dozen promoters today who are in a position to take on a project and put in the necessary equity? I can't even think of one. You agree, sir? Would you like to? One name, apart from even the Birlas.
No, but I do believe that if you have a good project and you've got a credible promoter on the other side, it's not difficult for people to line up behind that promoter and kind of give money to that particular
a promoter
project.
has to bring in his own equity. People cannot line up.
No, sure,
behind.
absolutely. No, I agree. I'm not saying that, look, everyone is going to come in and give equity, etc., etc. The promoter needs to bring in their own.
Could you tell me two promoters today who have money and who are credible and who will be backed by lenders for a 5,000, 6,000, 8,000 crore project?
We've got Tata sitting in the room, and I'm sure if you've
Apart from the Tatas, maybe.
You've got, we've got the Birlas also. If they were to kind of put their mind behind it, they would be able to get some money. And not, each of these businesses has their challenges, but I'm reasonably confident that they would be able to get money
let me ask you a tricky question. The quality of equity or the poor quality of equity is what has caused this NPA.
Sure.
And the fact that bankers lent to promoters to fund the equity, which RBI allows. It is shocking, but that is true. And bankers never check the quality of the equity. They believed the promoter who said that he would fund the equity from the cash flows of some project which was already in trouble.
No, I do agree that, you've got a lot of this funding which is going on at the holdco level, and therefore there is, in a sense, double leverage which is happening at the operating company level, which is, at the end of the day, behind a lot of the distress which we are seeing in the financial system today. But having said so, I think one of the things is, you'll see is that the survival instinct of Indian entrepreneurs is very high. And they kind of learn their lessons also pretty quickly. They forget it equally quickly. Let me put it that way. But they do learn their lessons at that stage, and therefore they will at this moment find their way. It could be in terms of, not investing as much. So if we kind of see some kind of step down in investment, maybe it's because the IBC and everything is biting them very hard today. And therefore they're saying that, look, let me be a little bit cautious. Let me not kind of set up a project because of the ego or because I want market share. I need to go back to the drawing board, just take small bites of businesses. If it's a 2 million ton capacity, let me set up 1 million and then 1 million later on. So that learning is there, and which is what we are seeing on today's date.
No, I just wanted to say I'm a little bit more optimistic than what you are, because to be frank, it's not that bad. And I think there is a kind of an entrepreneurial boom in India. There are private capital coming in, but there are also promoters who are willing to put in their capital, maybe not directly, they're leveraging themselves or from other sources. And there are some very good companies also. In fact, it would be a bit unfair to say that there is nobody, and I think otherwise we would not as a country would have sustained our growth. And I think it's a question, it takes two to a tango, in the sense that the credit mechanism has to have strong oversight. The lending standards post IBC, I'm optimistic, will change and is changing. And therefore, if that happens, there is a stronger oversight and the way in which companies manage themselves, because they know that if there is a mismanagement which is deliberate, the companies will not be there in their hands, which is what has happened, at least in the few cases that has become successful. So it takes time to change that mindset. I feel that IBC is one of the great legislations that has come. It has its own teething problems, but it will mature. But there are some very good companies also who have strong fundamentals, and I'm sure that if they have a project, they will put more than what is required, because if you believe in an underlying prospects of a company and the fundamentals are strong and the management is strong and the leadership is there, they would create value. And therefore, there are many companies who don't even go for borrowings. They're debt-free companies and they will do their projects on their own. So I think it's a mixed bag. The scar of what has happened in recent times is very big, but India is more robust than just this. And that's my optimism, and I think I'm not very wrong.
Do you think, he said that the credit culture is changing? That doesn't, see it, I mean, at least going by the current set of events, it's not changing at all. I mean, promoters are borrowing without informing the stock exchanges, borrowing through SPVs, through subsidiaries, without even informing other lenders. So, Ajay, you are sort of in the thick of this. I couldn't resist that.
No, but again, I think it's, you can't paint everybody with the same brush, Shobna. And I think the one thing that I think has changed is the fact that today promoters realize you could lose your company, and you can lose it very quickly, as we've seen in recent examples. I think that's never happened in India before. And I think that, to my mind, if that's not a wake-up call from a promoter side, nothing's going to be. That the fact that you can build something and you can lose it very quickly, that's a big change. That's a big change in process, as Kaushik said. It's also a very big change in mindset.
So actually, Shobna, I don't agree with you that it has not changed. I think we are being too much looking into the past. We also need to live in present and what will happen in the future. I think what has been said by my fellow panelists is absolutely right. I think NCLT is a big check. And to be frank, as a banker, I can tell you that there were times before NCLT when somebody defaulted. We used to really chase the person to say, pay up. I think that culture is completely behind. Today, people come back at least 3, 4, 6 months before and say that I may have a mismatch and I may default, and is there something that we can do today? I think it's a big, big change in the mindset, because they know that if they go to NCLT after the default, they are going to lose the company. That's one. Second, there are a lot of regulatory changes which have happened, and I'm not sure, whether everybody is aware of it. I think there is a system which Reserve Bank of India has now implemented. At the moment, it is only available to the banking system. We all have to report the defaults, even a one-day default. On a weekly basis, in a monthly basis, and then on the quarterly basis. At the moment, as I said, it is only to the banking system. So, I first thought there will be a lot of companies who will be there because it's a one-day default. Believe me, to my surprise, these were not really a large number of cases, but the usual suspect that we always knew were under the stress. And I have seen that over a period of time now, this is in existence for over 6 months, and we have seen that this list is just coming down, where people, are really making efforts to see that they do not default. Now, RBI is saying that they want to extend this to the outside the banking system, which is the mutual funds and the others. And they had set up the committee called PCR, Public Credit Repository. I was a part of that committee. Now we have the implementation committee. And I think with all these measures and the checks and balances, we will see the financial discipline coming back. And we have to agree that what has happened on the retail side with the credit bureaus, I think exactly will happen on the corporate side. And we all are a part of it, and we have to make it happen.
So since you're a banker, I won't ask you, but Amit, bankers don't want to report defaults. Otherwise, the process, 180-day, the February 12th circular should have kicked in for Jet Airways 6 months ago. By now, Jet Airways should have been in the NCLT. How come no banker reported? I'm sure they've defaulted not once, twice, but 20 times.
Sure.
And one-day default, certainly.
Look, everyone does try and talk their book up, so therefore it's no surprise. But I think
so then how will the credit culture improve?
No, but if you kind of go back and look at it over a period of time, from no recognition norms to 360 days to 180 to 90 days, the same is being extended to the NBFCs. SEBI did come up with a circular on a single-day default, which created a furore. But if you kind of go back, I'm sure if they were to propose something now, it would gain far greater acceptance. The other is, the point is in terms of whether it is out in the public and hitting the headlines, or whether the other banks are aware of it. From what Vishakha has described and what I understand of the system is, the banks pretty much are aware between themselves in terms of what's going on. They may not make a public disclosure. Now we can argue in terms of whether that's good or not, whether, you need a larger set of people who are now aware of the fact that a company is defaulted. And there's always this trade-off in terms of whether that would be more debilitating for the company or whether if you kind of keep it contained, you are going to be in a position to control the problem, and therefore it's a little bit easier to come out of it. I'm in the first camp which says that, okay, let's put it out in the open. But there are enough who would kind of tell me that, look, let's keep a lid on it. It kind of makes it a little bit easier to address the issue.
So, yeah, so my question
unless,
is
no,
that,
one minute.
Yeah.
Shobna, you're finding too much fault with promoters and borrowers. If there is no explicit cross-default clause, I think it's unfair to put it into the public domain if there is a default, which is a contractual thing.
I agree.
You know, there is an opportunity to roll over the contract or to exercise the rights under the contract between one bank and a borrower. But I think the regulators see themselves as guardians of all the lenders.
No, don't blame the regulators. Why are the bankers not honest? And the bankers are pampering the promoters. Because, well, I mean, to protect themselves.
Some bankers may be promoted.
I mean, you have an account which is 45,000 crore in debt, the company, and has still not gone to NCLT.
You know,
45,000 crores?
I don't know the situation in that company, but just putting without explicit cross-default clause, it's unfair for the Reserve Bank, for instance, to say that if there's a default in one place, it should be told to everyone else.
No, that's not the point. I'm asking you, why are the bankers not classifying the, and will this continue?
No, if I read Mr. Rajneesh Kumar's statement today in State Bank of India's exposure to Jet Airways, he said it was not in default till now. That's what he has said.
And even the 45,000 crore company was, no, so cannot pay 450 crore to an operational creditor?
I was not. But I want to also say that, you know, when you said that these promoters are borrowing from one source and another source and pledging shares.
And not telling us.
But what about the lenders? They're happy to lend, isn't it? So, I mean, why do you fault only one side?
No, I did. That's why I'm asking about the bankers and lenders.
No, so there is, I mean, mistakes have been made on all sides. I think the IBC is a salutary development for the country as a whole, that people suddenly realize that they cannot manage the banks. They cannot manage lenders as they did in the past. That bankers have an upper hand through the IBC now.
Do you agree? Because IBC has been there 2 years now. We are going to celebrate the second anniversary, but the pledge share issue is, it's just starting. I mean, the CRISIL put out a report yesterday which said that 90% of the 35,000 crore of pledged debt has a cover of less than 2 times, and in some cases the cover is 1.2 times.
So this afternoon I was, there is a IBBI working group on group insolvency, and I happened to be in that working group. See, the law, when it was structured, had to address one part of it, which was the entities or the legal entities which were in default. Now it is likely that it will expand to group, connected people. So it's spreading, and you have to give that, in a country like India, you have to give the time to for the law regulation to mature. From a fundamental principle point of view, I think it is in independent India, this is one of the landmark laws. So I think it will take time, and with that time, the credit culture will change. See, if you start spreading the net, that's why the group insolvency is important, because it is spreading beyond that legal entity. There are companies who have carved out assets elsewhere, kept it separate, all of that. If there's a catch-all approach towards IBC, automatically people will either get disciplined or they will lose the assets. And this will happen faster. So today, the IBC has timelines. It's the judiciary and the litigations which is extended the timelines. You know, so I think there are good chances, given the maturing of the resolution professional world, which is also happening pretty fast, because the first time people were trying to figure out, that it may happen that you might have, in say 3-5 years, very quick 180-day resolution, like that happens in the Western world. We just got to give some time. I think the first kind of impact has been made. If it becomes wider and wider, things will change, and things are changing. I know that you are seeing things, and mind you, there will be insolvencies. The very fact there is a law, there will be insolvencies. There will be potential bad judgments, bad projects, or mismanagement at will or otherwise. And therefore, the law should be institutionalized enough to take care of that. And it will go to good hands if the project is good. So it will happen. It's a question of, the tipping point has crossed. Now it's a question of how do you mature it.
Can I come in on this whole thing on promoter funding? I think what we are seeing at now is that for a long time you had issues with the operating companies, but you didn't know what was happening at the holdco level. For the first time, we are actually seeing what is happening at the holdco level, and what is the good news from at least the banker's perspective and most other lenders' perspective should be that the operating companies are doing well. And what you're seeing again is the fact that, whether it's the fear of the IBC or whether it's the change in the mindset, and we can quibble about the pace that it's not happening at a fast, but people are taking action. So if today you find that you've got Mindtree, which is in the news, it's because the promoter said, look, I have some other commitments, I'm going to sell my shares in the company and use it to repay it. You've kind of, in a sense, you've seen the same with Z. What they're able to accomplish, we don't know. So you are actually seeing a lot of steps. So it's a part of that whole change which is taking place in the environment at this stage. No, you would want it to, we should have reached this stage, all this should have been corrected 18 months ago, but unfortunately, this is the reality. We need to say that directionally, are we moving in the right direction? Yes. Maybe the pace is not what you and I might like, but I'm sure once some of these rules get established, some precedents get cast, then we will move pretty rapidly in this direction.
One thing you cannot blame banks on this is that banks have not left at all to this sector against loan against shares, because anyway we...
Yes. Okay, so we'll just get some concluding thoughts since you're so optimistic. How quickly, and you think that over-leverage hasn't killed India Inc. and that promoters will be back. So how soon are we going to see a private sector capex revival? 1 year, 2 years?
Private sector capex revival does not depend on borrowing. They will get the capital to expand if they would need to. I think it depends on the economic cycle. And I think the cycle is on the upswing. We will have a little bit of up and down because, last monsoon was bad, then the tightening up of credit stopped funds flows to banks, to housing companies and to NBFCs for auto lending and so on. So we are seeing a slowdown.
So are you saying the balance sheets are not so over-leveraged that they will be able to...
Clearly some sectors, they are over-leveraged. The infrastructure sector is a clearly, classic case of over-leveraging, over-optimism, unacceptable credit assessment and so on. But not every sector. You have consumer products companies, all cash-rich, pharmaceutical companies, almost all cash-rich.
Consumer product companies don't do capex much.
I'm
very little.
I'm chairman of Kansai Paints. We put up 3 plants in 1 year. In 1.5 years. So there's demand, there's growth. So that will drive capex.
Okay. Amit, you think that the over-leverage hasn't hurt and that they'll...
My sense is that where we are today is where we were 2 to 3 years ago, and people are still not investing. It's not so much on account of the fact that they don't have capital available, but on account of the fact that where are we in the capex cycle. My sense is that anecdotally, companies start investing when their capacity utilization has reached about 70% or so. This time what has happened is, while you're kind of crossed that 70% threshold, one is you've got assets available through IBC. So if someone's in the metal sector, they are going to make an acquisition there rather than spend
on a greenfield
and
project.
Therefore that money gets transferred. The second is you need to remember that, you know, with the change in the environment, global slowdown, the fact that you're now in the election season, people are going to wait, find out what's going to happen in the election and then start to spend the money. So we're seeing an uptick. Is it going to be, is the rate going to be, the second derivative going to be a lot faster? I think it's still about 12 to 18 months away before we see a big uptick.
Yeah, does anyone in the audience have a question? Some mics, if anyone. No? Yeah, Ms. Parekh, would you want to weigh in on anything? No? Okay, then fine. Vishakha, what do you think? You're the banker.
See, I think capital cycle is a function of what's happening in the plant at this stage. So I think most of the capacities are today not working at the optimum level. One has started seeing now the optimum level of utilization in few sectors. I think once you see that happening consistently, I mean, typically the companies think about the next level of capital expenditure. So, you know, we have started seeing that in steel. We have started seeing that in cement. You know, Kaushik can talk about, you know, his plans on the steel side, because we have seen now the steel, you know, the demand going up because of whatever is happening on the infrastructure side. One has started seeing cement demand going up because of what's happening. So I think once I think the cycle has started. It has to be a little more widespread.
What do you think?
So Shobna, my view is that, again, it's back to this whole issue of aggregates versus individual, because I think not all of India Inc. is over-leveraged, not all loan against shares is bad, not all sectors are over-leveraged, not all companies are over-leveraged, not all promoters are unable to start equity. I think everything ultimately works at a micro level in India, and I think, therefore, the framework that's been set in place will help people who are in difficulty find resolution through the resolution mechanism that's been put in place. People who have good projects, good track record will continue to get money and will continue to grow. And I think that's the way India has been in the past. The big delta is now that you have resolution, which I think helps on both sides. The promoter realizes he can lose an asset, but a lender also realizes you can actually recover money from your debt, which has never been the case before.
So you do think investment is coming back soon?
I think I agree with Amit. The 12 to 18 month cycle is what I would expect as well.
I think fundamentally, if one believes in the long-term story of India, then seasonality is not what will determine the capex. And if, as we see in India, more and more regulatory stability, it will draw capital. In fact, the IBC is a test. And if you look at cyclical sectors like steel, we can't decide on 1 quarter or 2 quarters whether we will make $3 billion, $4 billion of investment. So at this point of time, for example, we are more than doubling our capacity in Kalinganagar. We're spending about 24,000 crores to be spent over the next 2-3 years. That's because we believe that fundamentally steel is an important sector for the country, and there is demand, and there is consumers, and there is the right attractiveness to make that investments. It's our job to ensure that the project comes out well, and it's our job that we deploy the capital well and service it. So this is actually, if you look at many industries, invest in a counter-cyclical manner, because that's when the capex cost is lower. The equipment suppliers will give you better prices and so on. So I think capex will come back. It is a question. Just now we are in the season of elections. Some investors will look at stability and what happens post-May. But as I said, I'm optimistic about many sectors of the economy, not just mine, because I think everybody is looking at India as an opportunity for growth. We have had bad experiences. That's part of the game. So long we learn and pick ourselves as a country, I think we'll grow.
Okay. Thank you so much, all of you, Mr. Shah, Amit, Vishakha, Ajay, and Kaushik. Thank you, everyone.
Thank you so much, all our panelists and our moderator for that thought-provoking panel discussion. Ladies and gentlemen, another round of applause for all our panelists. Thank you very much. I now request Mr. Anand Goenka, Executive Director, the Express Group, to kindly join us on stage to share the welcome address. Welcome, sir.
Okay, you lead it. Thank you so much. Is this working fine? Ladies and gentlemen, on behalf of my father, Vivek Goenka, and the entire Express Group, once again, very warm welcome. Now, in front of Mr. Deepak Parekh, and is this working fine, guys? In front of Mr. Deepak Parekh, and in front of all you wizards of business, I know that I'm not foolish enough to embarrass myself by speaking on business and finance. So I thought I'd share instead a few thoughts about the evolving role of the CFO in a space that I'm a little bit more familiar with, and that is marketing. I think all around the world, and India is no exception, especially in the digital businesses, I find that CFOs spend a lot more time with the marketing chaps than I suspect they probably used to earlier. And certainly this has tremendously helped organizations change and evolve their marketing functions. Ads are no longer just about aesthetics and glamour, and CFOs aren't only getting involved to diplomatically reduce creative teams' budgets. Instead, marketing has grown much more scientific than it used to be. I think organizations are beginning to think of advertising not just as an expense, but as an investment with measurable returns. Metrics such as gross margin return on advertising expense. These are metrics I don't think that were probably very popular 15, 20 years ago. So again, I think this is a very welcome trend. But I wonder if I can leave you all here to reflect, have we overcorrected just a little bit? Are we focusing on performance advertising to such a degree that we are forgetting that successful brands are much more than their products? Brands that earn loyalty and thrive for generations, brands that build lifetime affinity with the customer, are in fact living, breathing, emotive entities. Now, to illustrate my point, I've rummaged through some of Express's archives. I think if you can have the PowerPoint on, if you just bear. Okay. Now, for the benefit of the CFOs in the room, I want to tell you that I tried very hard to fit this presentation in an Excel sheet, but it didn't work. So it's going to be a small PowerPoint. So you can see in the 50s, I'm just zooming into to an ad in the Express 1950 edition. You see the purpose of the advertisement here is to associate the brand with the product, and that's it. Beethoven is radio. Here's an ad in the 80s, where I think the purpose of the ad has evolved into associating the brand with the comparison. So there's a competitive aspect into the advertisement. So it's a superior quality, superior fit, or whatever. I think by the late 90s, if you notice by the late 90s, that the purpose of the ad really is to associate the brand with the customer, not just the product or the competitive positioning. If you come to the late 2000s, the early 2000s, sorry, you'll see here the purpose of the ad is to associate the brand with an emotion. So Coke is open happiness. Nike is just do it. If you really look at the evolution, what you're seeing, I think, is that the brand is really becoming as human as it can possibly be. And I think one of the traps of the connected, technology-enabled world is its ability to reduce marketing to an equation between marketing expense and the cost of user acquisition. I think it's very clear that marketing must be much more than that, because that's what audiences want. They want their favorite brands, brands that they interact with, to be as human as possible. And I think for that, the natural next step will be for brands to actually grow up and have an opinion, to join the national discourse and take a stand. I was surprised, for instance, to see the number of companies that invested in putting out ads when homosexuality was decriminalized. I've just got a few ads here that show this. It's not loading very properly, but if you see the sheer breadth of the number of companies, I mean, old, new, young, old, targeting younger audiences and targeting older audiences as well. The number of companies that actually wanted to make a statement saying that they supported decriminalizing homosexuality. I was surprised, and I don't know whether this would have probably happened 10, 15 years ago. In America, Apple and Google are probably some of the world's largest brands now. They were being baited by their fans every day to take a stand on Trump's policies. And probably rightfully, they arguably ducked those demands of their users. But I wanted to show you one Amazon ad that was released in the Super Bowl this year. Can you have that video, please? Ladies and gentlemen, all over the world, societies are getting polarized. Conversations are becoming heated. The smallest issue becomes political. In this environment, it's easy for boardrooms and for CFOs to ask brands to start playing it safe, to duck anything controversial, and to only advertise on machines and algorithms that calculate immediate return. And that certainly is a way of doing it. But my view is if your brand has to live on, the purpose of advertising has to go beyond thinking of trying to meet an ARPU target. It has to live on longer than, the brand has to live on for longer than the tenure of the CXOs that control it. And if it has to have an irrational loyalty from its customer, it has to act a little bit irrational. The brand has to open its mouth and once in a while take a stand, because that's the closest we can get our brands to being human. So once again, ladies and gentlemen, on behalf of the Express Group, a very warm welcome. Thank you very much.
Thank you, Mr. Anand Goenka. And now, ladies and gentlemen, we move forward to the much-awaited Financial Express CFO of the Year Awards 2019, embodying the Indian Express Group's spirit of excellence and credibility. Financial Express CFO of the Year Awards nominations witnessed thorough scrutiny by the Financial Express editorial team and our knowledge partner, Deloitte, to ensure that only the finest and most innovative companies were placed in front of the eminent jury. Guiding us through the ranking process was a distinguished jury panel comprising of corporate strategists, academicians, and thought leaders from the Indian corporate world, those who are well-respected innovators in the community. Ladies and gentlemen, the jury panel of the Financial Express CFO of the Year Awards 2019 includes Mr. Leo Puri, former Managing Director, UTI Asset Management; Mr. Amit Chandra, Managing Director, Bain Capital; Mr. Pradeep Shah, Founder, Ind Asia Fund Advisors; Mr. Paresh Shukthankar, former Deputy Managing Director, HDFC Bank; and Mr. Manish Kejriwal, Co-Founder, Managing Partner, Kedara Capital Investment Managers. Ladies and gentlemen, a loud round of applause, please, for all our jury members. Thank you very much for your investment of time. FE CFO Awards will award innovative companies across small, medium, and large enterprises in both manufacturing and services segments. We also have 3 very special awards: the FE CFO of the Year, the FE Newsmaker of the Year, and of course, the Lifetime Achievement Award. This year, at the behest of the eminent jury, we have done away with rankings. All segments will have winners who have been specially selected for their fantastic, credible work in their segments. Ladies and gentlemen, as we proceed further this evening, once again a reminder about tweeting and posting on social media. Go ahead and add the hashtag FE CFO Awards. Ladies and gentlemen, it is indeed an honor to have amidst us today Mr. Deepak Parekh, Chairman HDFC, as our chief guest. Ladies and gentlemen, as we now welcome Mr. Deepak Parekh onto stage to share words of wisdom with us. A loud round of applause, please. Sir, an honor.
Mr. Anand Goenka, Executive Director of the Express Group; Sunil Jain, Shobna, members of the Express Group, Financial Express Group, eminent jury members, CFOs, ladies and gentlemen. Thank you, Sunil, for inviting me here this evening. And before I begin, I wanted to just tell where's Shobna. Shobna, if journalists are so negative and not optimist, how can India progress? You will have more capex, you will have less leverage, private sector will find the necessary capital, less companies will go to NCLT, promoters will be better behaved and better disciplined, and India will progress. So we can't have so much negativism. Where is the capital going to come from? It will come, you will see. And I think as Vishaka said, I entirely agree that I see every cement company is talking of expansion. Every cement company in India. Similarly, steel companies are looking at. And all the companies that NCLT, through the NCLT process have been acquired, if you ask any of the acquirers, they say we have massive capital expenditure because some of these plants are mothballed and they have to improve and they have to modernize. So that capital expenditure is also happening as we speak. Anyway, it's a pleasure to be here. Thank you, Sunil, once again. Over the past few days, 4 days, the headline news of the Financial Express has had some funny caricatures and great achievements. Kaushik, I hope you saw your caricature. I think every CFO in this room would agree that we are in need of some non-crisis headlines for a change. Enough on stressed assets, tight liquidity, market volatility, missed targets, and anything else you may want to add to this list of growing gloom and doom. They say if you don't like the news, go out and make the news. The CFO Awards tonight makes for some very encouraging and optimistic news. Thank you, Anand, Sunil, and the entire team for recognizing this critical role of a CFO. Particularly in these challenging times, CFOs certainly observe to get the due credit. Financial Express has handpicked a great jury, led by Leo, along with Amit, Pradeep, Paresh, and Manish. I know all of them well, all of whom are exceptionally talented, all of whom are well experienced and have a strong eye for detail. The jury's job must not have been easy, but with the jury's varied experience and collective wisdom, I'm sure they have done justice to the assignment, to the task that was assigned to them by the Financial Express, and have picked out the real winners. I would like to congratulate all the winners tonight. I think there are about 24 of them, and I know each of you have done an outstanding job, whatever the circumstances have been. Of course, I must specially mention the stars of tonight. Everyone is a star, but I want to mention the 3 stars, Srinivas, Shashi, and Kaushik. They are the big boys of the street. And by big, I mean only by market capitalization. Kaushik only market cap, not big. Financial Express says that all 3 are very fit and proper, and I completely vouch for that. One is a 5 a.m. gymmer, the other is a vegan cum cyclist, and the third is a swimmer. More seriously, all 3 of you have truly proved to be the backbone of your respective companies. But do remember, awards are merely momentary joys. There are no real winners or losers tonight. We will all go back home this evening only to start afresh tomorrow, with new opportunities and new challenges facing us. To me, the real winners are those who stay optimistic. Shobna, stay optimistic. Who are solution seekers and have fire in their belly to take on the day's challenges. Winners are those who stay attuned and accountable to changing realities. Winners are those who admit they don't have all the answers themselves, but are willing to work with teams and other members to find optimal outcomes. Winners are those who take constructive criticism in their stride and stay humble and grounded. Now, we all know the job profile of a CFO has changed dramatically. And I'm not just talking about Ind AS and GST and taxation and all that. A sphere of influence, a CFO's sphere of influence has increased many times, as have the risks they need to manage. Yet, based on my years and years of experience, I've observed one aspect of a CFO has not changed at all. What hasn't changed is that when things go wrong, the first one to be blamed is a CFO. In boom times and easy liquidity, there's always the big boss taking the credit. When the cycle changes, funds dry up, projects get stuck, and financial results don't meet expectations, then no guess is who bears the brunt of it. So my advice to all CFOs is that if you can't change who gets blamed, try to make sure you don't get into trouble in the first place. Of course, it's easier said than done, but there's always going to be some unforeseen circumstances, some event, some lurking unknowns. One cannot anticipate all the risks in advance, and one has to face the risks and manage them. Yet, with all the past history that has been analyzed and documented globally, financial systems don't seem to learn much from the past. And as they say, those who do not learn the lessons of history are condemned to repeat them. So that's why we keep having boom and bust cycles with excesses on both cycles. As a CFO, you need to stay extremely alert during both the boom and bust times. Most bad decisions, and I repeat, most bad decisions are made in good times. And conversely, good decisions are made in tough times. Again, I was not aware that we were going to talk about leverage, but the two big L's I wanted to talk about are leverage and liquidity. And CFOs have to be guardians of both these L's. Leverage is a double-edged sword. It helps scale up businesses. It helps enhances returns. But it is this very tool that has been the cause of downfall of many. Leverage is like a waterline of a ship, the mark that keeps the ship afloat. If this level is breached, it becomes tougher to stay afloat. Yet the movement from leverage to over-leverage is a very fine line. Equity has to be raised when the ship is in calm waters. Sometimes, of course, equity comes as a rescue mission. But nowadays, very few are lucky to get the emergency rescue. Now, time and again, businesses erroneously believe that ships can transform themselves into submarines and they can continue doing business despite being underwater. So as a CFO, it's your job to raise red flags at the right time. Don't be a silent CFO, praying that things will get sorted out. Neither is it good enough for a CFO to say, I sounded a warning, but no one listened. You have to show spine. You have to speak up. You have to stand up. You have to hold your ground. Liquidity, or rather lack of liquidity, is the other bugbear. It's no-brainer when it's in easy liquidity conditions, a lot of borrowing happens at the shorter end of the market, which helps to widen spreads, as we have seen what has happened during the last year or so. The merriment of the party continues as long as there is ample surplus liquidity. And there is confidence in the system. But when confidence is shaken, we all know the domino effect it has. And we've seen this during the last 3 or 4 months, which have been very, very volatile and difficult for almost every company, both on the lenders as well as the borrowers. CFOs, you need to be agile and plan for contingencies. In today's times, you need more than just a plan B. The new normal is to expect the unexpected. Ultimately, it's about the tenacity to keep going and not giving up. A CFO must be the most trusted lieutenant of the promoter or the CEO. And it is not uncommon to find dominating CEOs or autocratic CEOs. Such CEOs may be excellent at what they do, but they're never good for an organization. It is here that the CFO must learn to play counterbalancing. CEOs often tend to have yes men around them. So it is important that a CFO be fearless to say no to a harebrained idea, a cowboy strategy, or something that can throw the financials out of whack. A dynamic CFO recognizes that he or she needs to look beyond the realm of finance. The role of a CFO is equally about developing and nurturing relationships. You have to deal with lenders, the board, the shareholders, the stakeholders, the auditors, the taxation people, regulators, and these relationships may put your value system to test, but there should be no shortcuts on ethics and principles. If you demonstrate prudence in your job, people in the organization will mirror the same. So it's your responsibility to demonstrate prudence, caution. Don't succumb to the pressures of short-termism, because this strategy does not reward stakeholders over the long term. See what has happened in the market. Everyone is gasping for liquidity during particularly the last 2 weeks. If you see, there's not a single company that doesn't want to borrow money because they want to square off their debts and they want to get their shares released as promoters. And the amount of requests that I've been getting practically from everyone in the last 2 weeks, I've never seen in 40 years in HDFC. So things are really not as good or so far as liquidity is concerned. As you know, the Reserve Bank of India has done large number of open market operations for the last 4 months. And they've put enough liquidity into the system. But that liquidity is in the banking system. It is now the banking system has to lend money, and the banks have stopped lending or have been very cautious lending. They're not lending to real estate. They're not lending to NBFCs. They are very cautious in lending. The banks have enough liquidity today, but the companies do not have liquidity. So to conclude, the last couple of years have been unduly difficult. Financial failure so often gets construed as financial fraud. A wrong commercial call cannot be equated to malintent. Punishment cannot be meted out for a bona fide transactions that have gone wrong. Bankers have to get back to the business of lending. Companies have to get back to expanding and building India with financial discipline. Unviable institutions must be allowed to wind down, and the bankruptcy system has to be ring-fenced to prevent long overdues and long-drawn legal battles. More resolutions are also being found outside the bankruptcy framework, and this gives me optimism to believe that India Inc. is getting its mojo back. If you see the number of cases that NCLT has handled, they may have cleared very few, but many of them have been cleared out of NCLT. Once the banker files with NCLT, then the settlement starts. And this is a very great achievement of the government to have this bankruptcy system, because it puts a fear of God in the minds of the promoter. Once it goes into NCLT, they go out. And no one wants to lose their company. So after it is filed with NCLT, we recently did the case, 21 days it was with NCLT. The promoters came and agreed to sell their company. Earlier, they were not listening and they're not paying anyone. So I think the implementation of NCLT the implementation of the Act has been an excellent move, and this will help the banking system. And what better testimony to this can we have than honoring India's finest CFOs? So once again, congratulations. I'm sorry I've not named each and every of you, but there are so many of you. And the 3 that I've named, I've worked with these companies. One is our own bank. Hindustan Lever, I've been on the board for many years. And Tata's is like family to me. So I'm delighted that the big candidates are all well-deserving and fit and proper. Congratulations once again.
Requesting you, sir. Thank you so much, sir. Your words always inspire. And can you please join us center stage? And I'm now going to invite Mr. Anand Goenka, Executive Director, the Indian Express Group, to present a beautiful token of appreciation to Mr. Deepak Parekh. Thank you. Ladies and gentlemen, and now, ladies and gentlemen, we move on to that part of the evening that we have all been eagerly waiting for, the Financial Express CFO of the Year Awards 2019. To present the first set of awards, along with our dignitaries on stage, I invite Mr. Yogesh Lakhani, Chairman and Managing Director, Bright Outdoor, to join us. Welcome, sir. Ladies and gentlemen, we now begin with the first category, the Financial Express CFO Awards, Small Enterprises. This award felicitates companies that have a gross turnover of less than 500 crore rupees across the manufacturing and services sector. In the small enterprises services segment, the winner for the Financial Express CFO Awards 2019 is Alpha Geo Limited. Ladies and gentlemen, we welcome on the stage Mr. Venkatesa Perumallu Pasumarthi, Chief Financial Officer, Alpha Geo. Welcome, sir. Congratulations. Our next winner for the Financial Express CFO Awards 2019 in the same category is Nesco Limited. Ladies and gentlemen, please put your hands together as we welcome on stage Mr. Dipesh R. Singhania, Chief Financial Officer and Head Legal, Nesco. Congratulations, sir. Thank you, Mr. Lakhani. Thank you very much. May I now invite Mr. Porus Doctor, Asia Pacific Leader, CFO Program and Partner, Deloitte India, to kindly join us on stage to present the next set of awards along with our dignitaries. Welcome, sir. In the small enterprise services segment, our next winner for the Financial Express CFO Awards 2019 is Shemaru Entertainment Limited. Ladies and gentlemen, unfortunately, Mr. Hiren Gada, Chief Financial Officer, Shemaru, is unable to join us here today. May we request a representative from the Shemaru team to join us. Welcome. Ladies and gentlemen, in the small enterprise services segment, our next winner for the Financial Express CFO Awards 2019 is Deep Industries Limited. Ladies and gentlemen, please welcome on the stage Mr. Chintan Parekh, Head of Accounts, Deep Industries. Congratulations. Congratulations, sir. Thank you very much, Mr. Doctor. Thank you for joining us on stage. We also request our winners, as you step off stage, you will be escorted to a special interview. Our next set of awards are in the small enterprise manufacturing segment. The first winner in this category, right here at the Financial Express CFO Awards 2019, is Valiant Organics Limited. Ladies and gentlemen, please welcome on the stage Mr. Arvind Kanji Cheda, Director and Chief Financial Officer, Valiant Organics. Welcome, sir. Congratulations. Ladies and gentlemen, congratulations to Mr. Cheda. Our next winner in the same segment, small enterprise manufacturing segment, is Genbergt Pharma Limited. May I please welcome on the stage Mr. Dilip Bhuta, Whole-Time Director and Chief Financial Officer, Genbergt Pharma, to accept the award. Congratulations. Ladies and gentlemen, please put your hands together for Mr. Bhuta. Continuing in this category, Small Enterprise Manufacturing segment, our next winner for the Financial Express CFO Awards 2019 is Multibase India Limited. Ladies and gentlemen, put your hands together as we welcome on the stage Mr. Satya Nagesh Ventrapragada, Chief Financial Officer, Multibase India. Congratulations. Congratulations, Mr. Ventrapragada. Ladies and gentlemen, may I now invite Mr. Kailash Jadhav, Joint CEO MIDC, onto stage to join our dignitaries. Welcome, sir. Ladies and gentlemen, as we proceed, once again, a quick reminder, if you're tweeting or posting on social media, please make sure that you add the hashtag FE CFO Awards. Moving on to the next category, which is Medium Enterprises segment, companies that have a gross turnover of between 500 to 1,000 crore rupees. We now begin with the Services segment. The winner in the Medium Enterprises Services category for the FE CFO Awards 2019 is Kovai Medical Center and Hospitals Limited. Ladies and gentlemen, welcome on the stage Mr. M.K. Ravindra Kumar, Chief Financial Officer, Kovai Medical Center and Hospitals. Congratulations, sir. The next winner in the Medium Enterprises Services segment for the FE CFO Awards 2019 is TCI Express Limited. Ladies and gentlemen, a loud round of applause for Mr. Mukti Lal, Associate Vice President and Chief Financial Officer, TCI Express. Joining us on stage, congratulations to you, sir. We continue with the same category, Medium Enterprises Services segment. The next winner is New Gen Software and Technologies Limited. Congratulations, Mr. Arun Kumar Gupta, Chief Financial Officer, New Gen Software and Technologies. Congratulations, Mr. Gupta. The next winner in the Medium Enterprises Services segment for the FE CFO Awards 2019 is Shreyas Shipping and Logistics Limited. Ladies and gentlemen, put your hands together as we welcome Mr. Rajesh Desai, Chief Financial Officer, Shreyas Shipping and Logistics. Congratulations, Mr. Desai. Thank you, Mr. Jadhav. Thank you for joining us on stage. Ladies and gentlemen, as we move forward right now, we hope that you are creating a buzz on social media. Let's move on to the next set of awards in Medium Enterprises Manufacturing category. The winner in the Manufacturing segment for the FE CFO Awards 2019 is Eris Life Sciences Limited. Ladies and gentlemen, welcome on the stage Mr. Sachin Shah, Chief Financial Officer, Eris Life Sciences, to accept the award. Congratulations, Mr. Shah. Our next winner in the Medium Enterprises Manufacturing segment is Kaplan Point Laboratories Limited. Ladies and gentlemen, welcome on the stage Mr. D. Muralidharan, Chief Financial Officer, Kaplan Point Laboratories, joining us on stage to accept his award. Congratulations, Mr. Muralidharan. In the Medium Enterprise Manufacturing segment, our next winner for the Financial Express CFO Awards 2019 is Balaji Amines Limited. Ladies and gentlemen, welcome on the stage Mr. G. Hemant Reddy, Director and Chief Financial Officer, Balaji Amines. Welcome, sir. Congratulations. Ladies and gentlemen, we continue in the same category, Medium Enterprise Manufacturing segment. And our next winner is NoSil Limited. Please welcome on the stage with a loud round of applause, Mr. P. Srinivasan, President Finance and Chief Financial Officer, NoSil. Congratulations, sir. Welcome. Congratulations, Mr. Srinivasan. Ladies and gentlemen, to now present the next set of awards, I welcome on the stage Ms. Preeti Mankotia, Director Partnerships and Alliances, SAP Concur, to join us and our dignitaries on stage. Ladies and gentlemen, the next set of awards pertain to the large enterprises category. Now, these are companies with a gross turnover of over 1,000 crore rupees. These awards will be given to companies across the two sectors, services and manufacturing. Our first winner in the large enterprises services category for the Financial Express CFO Awards 2019 is Oracle Financial Services Limited. Please welcome Mr. Makarand Padalkar, Chief Financial Officer, Oracle Financial Services. Welcome, sir. Congratulations, Mr. Padalkar. Moving on, the next winner in large enterprise services category is CRISIL Limited. Ladies and gentlemen, put your hands together. Welcome on stage, Mr. Sanjay Chakrabarty, President and Chief Financial Officer, CRISIL Limited, to accept the award. Congratulations, Mr. Chakrabarty. The next winner in large enterprise services segment is L&T Technology Services Limited. Ladies and gentlemen, put your hands together for Mr. P. Ramakrishnan, Chief Financial Officer, L&T Technology Services. Congratulations, sir. Congratulations, Mr. Ramakrishnan. The next winner in Large Enterprises Services segment for FE CFO Awards 2019 is Tata Elxsi Limited. Ladies and gentlemen, joining us on stage, we welcome Mr. H.V. Muralidharan, Chief Financial Officer, Tata Elxsi. Ladies and gentlemen, with a loud round of applause, let's congratulate Mr. Muralidharan. Thank you so much, ma'am. Thank you for joining us on stage. Ladies and gentlemen, may I now invite Mr. Prakash Shah, Director Finance and Business Development, Hirnandani Group, and Mr. George Varghese, Group CEO, the Express Group, to kindly join us on stage to present the final set of awards. Ladies and gentlemen, large enterprise manufacturing segment is where we are at. The winner for FE CFO Awards 2019 is Hindustan Unilever Limited. Please put your hands together as we welcome Ms. Asha Gopalakrishnan, Finance Director, Hindustan Unilever, to kindly join us on stage. Congratulations, Ms. Gopalakrishnan. The next winner in the same category, Large Enterprises Manufacturing segment, is Natco Pharma Limited. Ladies and gentlemen, we welcome on the stage Mr. Appa Rao, SSVN, Chief Financial Officer, Natco Pharma, to join us on stage and accept this award. Ladies and gentlemen, please put your hands together. Mr. Appa Rao, congratulations, sir. Moving on to our next winner in Large Enterprises Manufacturing segment is GSK Consumer Healthcare Limited. Ladies and gentlemen, put your hands together as we welcome Mr. Vivek Anand, Executive Vice President Finance, GSK Consumer Healthcare. Congratulations, Mr. Anand. And our final winner in Large Enterprise Manufacturing segment for FE CFO Awards 2019, and the award goes to P&G Hygiene and Healthcare Limited. Ladies and gentlemen, please welcome on stage Mr. Prashant Bhatnagar, Chief Financial Officer, P&G Hygiene and Healthcare. Congratulations, sir. Ladies and gentlemen, we now come to that special segment of awards, which recognizes the distinctive role that leaders in the industry have played in their individual capacity in the development of their organizations and the industry. Now, these awards are based on special nominations by the Financial Express editorial team and the esteemed jury. So the first award in the individual capacity is for Financial Express CFO of the Year. It recognizes a leader who, with his innovative ideas, business excellence, and strategic leadership, has propelled the company to heightened success. Ladies and gentlemen, the Financial Express CFO of the Year 2019 goes to a gentleman who has just overseen one of the biggest M&A transactions in the FMCG space, the merger of the GSK Consumer Healthcare India business with Hindustan Unilever. It wasn't an easy deal, but he says once the team was convinced there was a compelling rationale for the merger and there were significant synergies, 800 to 1,000 basis points to be gained, half the battle was won. Where he and his team scored big was in pushing through an all-stock deal. GSK had reportedly been more keen on a cash transaction. The jury felt he had done a tremendous job in structuring the deal so well. For this achievement, ladies and gentlemen, he was the obvious choice for CFO of the Year. Ladies and gentlemen, the Financial Express CFO of the Year 2019 is Mr. Srinivas Parekh, Executive Director, Finance and IT and Chief Financial Officer, Hindustan Unilever. Ladies and gentlemen, unfortunately, Mr. Parekh is traveling overseas and couldn't make it for the ceremony here today. I now invite Mr. Kannan Ganesan, General Manager Finance for Sales and Customer Development, Hindustan Unilever, to kindly join us on stage and receive the award on his behalf. A thunderous round of applause, ladies and gentlemen. Congratulations to Mr. Srinivas Parekh, the Financial Express CFO of the Year 2019. Ladies and gentlemen, the second award in the individual capacity is the FE Newsmaker of the Year Award 2019. It recognizes a leader who has made the biggest news splash in the last year with his innovative ideas, business excellence, and overall progress for the company. HDFC Bank has always had the cleanest book in the business. But what is important is that every rule in the book has been followed with strict corporate governance standards. Even as he takes thousands of decisions, he is conscious of compliance, cognizant about risk, and conservative while assessing market practices. For having managed an impeccable balance sheet at a time when the banking sector has been under severe stress, the jury felt he was especially worthy of recognition. If HDFC Bank has a stellar reputation, much of the credit goes to Mr. Shashidhar Jagdishan. Ladies and gentlemen, FE Newsmaker of the Year Award 2019 goes to Mr. Shashidhar Jagdishan, Chief Financial Officer, HDFC Bank. A much louder round of applause, ladies and gentlemen. Join us in congratulating him. Ladies and gentlemen, let's put our hands together. Newsmaker of the Year Award 2019 goes to Mr. Jagdishan. Congratulations, sir. And of course, we request you to please share a few words with us. Requesting you, sir, to kindly share a few words with us.
To the Financial Express Group, to the eminent jury members for conferring me on this award. Thank you so much. I humbly accept this on behalf of the 100,000 plus employees of HDFC Bank. I think Sunil was mentioning that a lot of glorious and exotic things what a CFO does, but frankly, my job has been very easy. It's been one of the easiest. I'm blessed to be a part of an organization which in a noisy but a vibrant country as someone says, India is the best destination in a sector which is underpenetrated, underserved, so the opportunity to grow is huge. Under a CEO whose leadership, vision, strategy, and his obsession for processes is a folklore. To all the seniors through the 25-year journey who have built a solid foundation of ethics, ethos, strong credit discipline, and compliance discipline, which is now a part and parcel of our culture now. We may have done pretty well all these years, but we believe that the best of the bank is yet to come. I've been lucky to have been there at the right place at the right time. God has been very kind. I thank the good Lord. I thank my family and my wonderful team for supporting this wonderful journey. Fortunately, my wife is not there, otherwise I would have had to extend the speech for longer. So thank you so much. Thank you.
Congratulations, sir. Ladies and gentlemen, we now come to the final award for the evening. Financial Express CFO Award, the Lifetime Achievement Award 2019. This award is being conferred on a veteran financial professional who, with his vision and exemplary contribution, has not only shaped the future of the Indian industry, but has become an inspiration to many. This gentleman became CFO at Tata Steel at 36, and within 2 years of this was called upon to fund the $12 billion Chorus acquisition. He and his team rustled up $6 billion of debt and later refinanced an LBO with a corporate funding mechanism which was not marketplace in those days, especially in Europe. With the subsequent collapse in steel prices denting Chorus's bottom line, he and his team were continuously refinancing the loans. Some $60 billion has been invested in Tata Steel over the 12-year period, a mix of loans, equity, hybrids, bonds, and CARS, even as the underlying business remained fragile. At one point, the company's net debt to EBITDA was nudging 10 times, but not once did the company breach the covenants. Ladies and gentlemen, for this achievement, Mr. Kaushik Chatterjee, Executive Director and Chief Financial Officer, Tata Steel, wins the FE CFO Lifetime Achievement Award. Ladies and gentlemen, this is the Lifetime Achievement Award. A thunderous round of applause. And as you acknowledge the contribution, a standing ovation. I see a few people standing. Congratulations to you, sir. Ladies and gentlemen, FE CFO Lifetime Achievement Award goes to Mr. Chatterjee. Sir, we request you to kindly share a few words with us.
Thank you very much, ladies and gentlemen. Thank you, Mr. Parekh. It's an honor to receive the award from you. Thank you, Financial Express, the jury. This has been, when Shobana first told me that this is the award that the Financial Express jury has decided on you, and I was just wondering, lifetime achievement at 50, what do I do next? And is there a message? So, well, it's by tenure a 15-year journey. For this, I have to thank a few people. My parents, of course, for their grounding and support during my formative years. my wife Tanya and my son Anirudh, who's kind of borne the brunt of the last 15 years, being a guest parent and a often infrequent visitor to home. And certainly to my chairman, Mr. Tata, and Mr. Muthuraman, who've been the originator of this journey when I was all of about 36. And this was not a position that actually I aspired for at that point of time, because I was doing something which I thought was the best project that a finance guy could do, and that was the TCS IPO. So when Mr. Muthuraman in 2003 came and said, I want you back in Tata Steel, he didn't say that what he wanted me out of my movement. I just said that, I'm doing something which is very exciting, and I don't think that I'm interested in going back. And I used to work then in Tata Sons, a brief period of 5 years. And my boss at that time was Mr. Ishat Hussain, who's been a kind of a mentor and a life coach for me ever since he picked me up from Jamshedpur in 1999. And I actually was upset with him because I thought he's nudged Mr. Muthuraman to take me back in Tata Steel. And I told him that I'm doing this fantastic work, which I think is very interesting, and you want me to push me back to Jamshedpur. So he said, look, it is Muthu's idea, not mine. And he has this famous phrase of his. He says, I have no chacha and I have no bhatija. So neither I take any support from anybody, nor do I recommend anybody. So it's your call, but don't regret it if you don't take it 5 years later. So that was the start of the journey. Possibly one of the most untrained CFOs to take the job of a large company like Tata Steel. But ever since, it's been tough at many points in time, but it's been a journey of learning all along. We've done a significant amount of financing work, setting up a team, and doing things which perhaps many of us did not get trained to do. And I just must say that it's been a fantastic platform at the Tata Group and at Tata Steel, which enables professionals like us to work with freedom, to learn, fail, and relearn, and ensure that the only thing that we need to focus on is what is in the best interest of the company. And I think if many people in the last couple of days have referred to the article that Shobhana has written, and the starting part of the article, and said that we didn't know you had these kind of experiences. I would only say this at the end, that there are experiences in life for which we are not trained, prepared, or expecting. And as professionals, or as even human beings, we just need to ensure that if we can keep our focus, work sincerely, work with integrity, and even if you are in the worst period of your professional or personal life, if one has the basic elements right, they would certainly come out, because nature's momentum takes you out of these situations if your intent and interest are correctly aligned. I have just done that. I have also only tried to keep complex things simple. I have a fantastic team, and I'm grateful to each member of them. And this is truly a recognition for them and all the members of the Tata Steel family. And this is something which is a moment to cherish for all of my family and the extended family. And I wish that all of you who've been aspiring professionals as CFOs or CFOs, I can only say that you don't need any rocket science. It's the basic elements and hard work and integrity that gives us a beautiful journey in our professional life. Thank you very much. God bless you all.
Congratulations, sir. Requesting you to continue to be with us on stage. Requesting you to continue to be with us on stage because, ladies and gentlemen, we now request all our winners and partners to kindly join us on stage for a group photograph with our distinguished chief guest, Mr. Deepak Parekh. May I request Mr. Lakhani from Right Outdoor, Mr. Porus Doctor, Deloitte India, Mr. Jadhav from MIDC. We request every partner to join us from SAP Concur, from Hirunandani Group, Mr. Shah. We request Mr. Sunil Jain, Managing Editor, Financial Express, Mr. George Varghese, Group CEO, to continue to be with us on stage. Congratulations to all our winners on stage. Right here at the FE CFO Awards 2019. Ladies and gentlemen, we'd like to thank each and every one of you for joining us this evening and making it an evening of unparalleled success. An initiative of this scale and proportion could not have been achieved without the unstinting support from numerous quarters. We would like to thank our partners, associate partners, Hirunandani Group, New India Assurance, MIDC and SAP Concur, Auto Partner, Volkswagen, Knowledge Partner, Deloitte India, Television Partner, BTVI, Outdoor Partner, Bright Outdoor Media. Ladies and gentlemen, it was indeed a pleasure having you all honoring the best financial minds in India, Inc. Ladies and gentlemen, as we congratulate all our winners on stage, we set the stage for the perfect group photograph, honoring the best financial minds in India, Inc. Ladies and gentlemen, with us on stage, the recipients of the FE CFO Awards 2019. Please put your hands together, honoring the best financial minds in India, Inc. Congratulations. Thank you, ladies and gentlemen, for joining us today. We hope to see you around next year as well, as we look forward to an evening of celebration. My name is Keisha Lobo, and thank you so much for joining us this evening and making it a grand success. Thank you. Thank you.